In late July 2021, more than $1 billion worth of crypto assets were sold or dumped in a single day as the price of Bitcoin rose over $40,000. We're going to explain how crypto assets can be shorted and what shorting Bitcoin actually means for the future of the crypto market. So today we're looking at how a short squeeze puts a rocket under crypto markets plus other related crypto content. You do not want to miss this list. First up, let's look at what a short squeeze is. Most beginner investors think that the way you make money on a stock or crypto trade is by buying low, holding onto the stock or crypto asset for an indefinite period of time until the price rises, and then selling the stock or crypto. While this strategy or philosophy can make investors money, it certainly isn't the only strategy available to investors, particularly the more seasoned or sophisticated investors. This type of investor is commonly referred to as a short seller. The latter class of investors will sometimes bet that the price of a stock will go down and can also make money this way as well by using financial instruments known as derivatives. Essentially, derivatives are a type of financial product or instrument that comes in the form of futures or options contracts. In this scenario, if the short seller bets that the price of a stock or crypto will fall but the price increases instead, then the short seller is in a very precarious position and risks losing some or all of his money. When this type of event occurs, it's known as a short squeeze. Next up, we'll look at what a crypto short looks like. Many investors are curious to know whether or not it is possible to short sell cryptocurrencies as can be done with regular stocks. The answer is yes, absolutely. It's no secret that Bitcoin, the flagship cryptocurrency that started the entire crypto craze and revolution, is extremely volatile. For instance, all it takes for the price and value of Bitcoin to fluctuate wildly is a single tweet from Elon Musk or anti-crypto legislation being introduced in China. What happens in the real world directly impacts the intangible crypto asset in real time. If some Bitcoin investors feel that the price of crypto is set to crash, they will panic sell and get out, causing a sharp drop in price and value. Likewise, if a positive tweet from Musk or some pro-crypto piece of legislation is introduced in some part of the world, investors may think the price is going to go up and will rally and buy. When there's rally buying, the price shoots up. Next up, we'll look at how a recent short squeeze is expected to propel the value of crypto to the stars, like a SpaceX rocket. In late July of 2021, nearly 1 million derivatives short sellers collectively sold their crypto assets in a single day. The value of this hasty liquidation, which happened in only a few hours, is estimated to be valued at more than $1 billion. Investors with long-term crypto bets made substantial profits, but the price fluctuation cost short sellers one of the biggest crypto market losses ever. On that day, the price of futures contracts jumped up from $38,000 to $48,000, and at the time of this recording, Bitcoin is currently sitting at a price of around $45,000 per coin, but analysts predict it could be heading toward the $100,000 mark. Crypto analysts are calling this event the single biggest short squeeze in crypto market history because it happened in such a short time frame, being only a few hours. Similarly, in late December of 2021, there was another short squeeze that saw $1 billion worth of short sales, but that event occurred over the span of about a week. Up next, we'll look at more similar events in the up and down world of crypto trading. 1 month after the week-long short squeeze of late December 2021, Elon Musk and his company Tesla released a statement announcing that they would accept Bitcoin from consumers wishing to purchase their vehicles and products. This resulted in short sellers liquidating $500 million worth of Bitcoin. Later, Musk edited his Twitter biography to include the hashtag Bitcoin. The end result? A massive short squeeze of $1.2 billion. Although the value of this short sell liquidation is larger in dollars than the record-setting short squeeze, it took longer to unfurl. Therefore, it does not hold the record for the biggest short squeeze of all time. Remember, it is the measure of time and not solely the dollar value of a short squeeze that determines just how big it is. Next up, let's take a closer look at how the most recent short squeeze came to fruition. Back in May and June of 2021, crypto market prices were trending downward. This was the direct result of China's crackdown on cryptocurrencies that we talked about earlier, as well as new regulations and a general drop in buys. This perfect storm of events caused the value of Bitcoin to plummet by, get this, a few $100 billion. By mid-July, the price of Bitcoin had plummeted to $30,000 per coin. Incredible. Talk about a roller coaster ride for this flagship cryptocurrency. This is why if you're planning to invest in crypto, you should do some research and ensure that you understand what you're getting yourself into. If you're thinking of investing in futures or options contracts, understand that these financial products are much more complex than a straightforward crypto purchase and require a much higher level of knowledge and expertise. Up next, we'll discuss the differences between the two main crypto markets. There are more factors that have the ability to cause a short squeeze, but first we have to understand the differences between the two main crypto trading markets. The first is what is known as the spot market, and the second is known as the derivative market. It's important to understand the difference between the two markets. The biggest short squeeze in Bitcoin history happened in the derivative market. First, let's discuss the spot market. The spot market is where most beginner and intermediate crypto traders find themselves. In the less complex spot market is where you'll see investors doing straightforward cryptocurrency trades, that is, the simple buying and selling of crypto. In the more complex derivative market is where you'll see investors trading crypto futures known as perpetual contracts, as well as cryptocurrency options contracts. In 2021, the derivative market saw by far the most trading activity, and crypto analysts were quick to notice a trend. They noticed that most of the investors were betting against Bitcoin, believing that the price of the cryptocurrency would fall dramatically. Analysts also discovered that many investors had used leverage for their crypto short sell positions. Essentially, leverage in the stock trading world means using leverage that will allow you to pay less for your investment or trade without having to pay the full price of the investment up front. It's comparable to trading in a margin account with borrowed money for your investments. Next up, understanding why crypto trading means high volatility. The fledgling crypto market is thought to be the most highly volatile investment market in the world. As of now, that naturally makes it the riskiest market to invest in because this new burgeoning market is still in its infancy. It's hypersensitive, and as we've seen, a single tweet from a famous person or a news article is enough to send cryptocurrencies into a tailspin and send them soaring to the moon. After Amazon released a statement that it would be accepting Bitcoin as a method of payment, the price swiftly shot up to $30,000 per coin. Short sellers took advantage of this opportunity and rallied in a buying frenzy to buy Bitcoin at a higher price in order to offset the losses they sustained from their bad short bets. This buying frenzy is what precipitated the short squeeze, which is why the value of Bitcoin shot up so rapidly. For outsiders looking in, all this volatility may seem a little crazy, and one can't help but wonder if all of this volatility is a good reason to stay away from crypto investing. But for experienced crypto traders, these wild price fluctuations are nothing new. It's just the nature of the crypto world beast, so to speak. Finally, what's next for the future of crypto? To be perfectly honest, the future of the crypto market looks bright, with more and more platforms, software applications, and corporations starting to accept Bitcoin as a form of payment. For the most part, this is a positive development. However, there are pockets of people who feel that this currency revolution of sorts will lead to havens for drug lords and organized crime groups to be able to launder the proceeds of their dirty deeds. Whether such shady laundering will take place or not seems to detract from the real important question of whether crypto trading is a good investment vehicle. We think the answer to that question is clear. Yes, it can be, but only if you do your research, and only if you're prepared to lose what you've invested. Remember, the main thing to always keep in mind is that you're investing in what is, hands down, the most volatile financial product in the world. You can make a ton of cash? Absolutely, but it is not a get-rich-quick scheme. Crypto trading is a long game, and becoming a savvy crypto trader takes a heck of a lot of hard work, time, and effort. Thank you for listening and watching. Please click like and subscribe to our channel. More exciting and informative videos are on the way.